Vertical spreads are the most important option strategy to master as a beginner. But there are many vertical spread concepts that so many people get wrong that once learned will take your options trading IQ to the next level. The way I'm going to approach this video is by using option pricing calculators to simulate changes in the variables that impact how options are priced. And by changing these variables, we can understand how these positions change value when we change implied volatility, when the stock price changes, and when we experience the passage of time. So first I want to illustrate how a vertical spread's theta position and Vega position will change as the stock price changes relative to the strike prices of that particular vertical spread. So for this first example, we're looking at a 100-110 call spread, and we're going to look at the spread's theta and Vega position as the stock price moves from $100, or the long call strike price, to $110, which is the short call strike price. As we can see in this graphic, if the stock price is at $100, which is the long call strike price, the spread has negative theta and positive Vega, which means it will lose value from the passage of time, and it will gain value from increases in implied volatility or lose value from decreases in implied volatility. But as we can see, the theta and Vega position of this call spread does not remain constant. The Greeks actually flip positions as the stock price increases towards that higher call options strike price. What this means in plain English is that if I buy a call spread with the strike prices of 100 and 110, meaning I buy the 100 call and short the 110 call, if the stock price is near the long call strike price of 100, my spread is going to have negative theta and positive Vega, meaning that I will lose money from the passage of time and I will gain value or profit from increases in implied volatility. Or if implied volatility falls, I will lose even more money as implied volatility is falling and time is passing. However, if the stock price increases favorably and increases to the short call strike price of 110, my vertical spread will actually become positive theta, meaning that it will benefit from the passage of time, and negative Vega, which means that it will increase in price if implied volatility falls. So I want to start here, but I want to further isolate these changes. And first, we're going to look at changes in implied volatility, and then we're going to look at changes in the passage of time, and then we're going to bring it all together and look at a scenario where the stock price is changing and time is passing, and we're also seeing changes in implied volatility to see which scenario results in the best vertical spread performance. For this first test, we're going to look at how a vertical spread, namely a call spread, changes value as we have a decrease in implied volatility, and we're going to look at a decrease in implied volatility when the stock price is at two levels. So for this initial test, we're looking at a theoretical 100-105 call spread with the stock price pinned at $100, which is the long call strike price if I were to purchase this spread. Now we're going to look at the spread's value as we take implied volatility from 30% down to 20%. And here's what we get. As we can see, if the stock price is at $100 and I own this 100-105 call spread, as I mentioned earlier, the spread's Vega position will be positive, meaning that it will increase in value if implied volatility increases and decrease in value if implied volatility falls. As we can see in this graph here, when the stock price is at $100, the value of the 100-105 call spread decreases as implied volatility falls from 30% to 20%. Now let's look at the same exact test, except the only difference is going to be that the stock price is not at $100, but the stock price is at $105, which is the short call strike price in this particular example. And that means that my call spread will be fully in the money. And as we're decreasing implied volatility, we'll be able to see how that changes the value of the spread. So here's what we get. This time around, we can see that the spread's value actually increases steadily as the stock price is at $105 and implied volatility is decreasing. The reason this is happening is, as I described, as the stock price goes from your long call strike price to the short call strike price, the spread's Vega position flips negative. And once the spread is fully in the money, it has a negative Vega position, meaning that it will increase in value as implied volatility falls. How to interpret this intuitively is to understand that once your spread is fully in the money and implied volatility is falling, that means that the stock's expected range in the future is also shrinking. And that means that there's a higher probability that the spread will expire fully in the money, because since it is fully in the money and the expected movements of the stock are falling, there's a higher probability that the spread will remain in the money through expiration and receive its maximum potential value when it expires. This first example illustrates that if you buy a vertical spread and the stock price is near the long option strike price, you want implied volatility to increase because that will benefit the value of your spread. But if the stock price changes favorably and ends up at your short option strike price, your spread will now be negative Vega, and you want implied volatility to decrease, and that will lead to an increase in the value of your vertical spread. Really quickly, before we move forward, I just wanted to mention that tastyworks, the brokerage platform that I've been using for years and love, is putting on a promotion right now where you can earn $200 in free stock as a bonus for signing up and funding your first account with $2,000 or more. I love tastyworks because of their intuitive trading platform and their trader-friendly commissions. Specifically, their option contract fee is $1 per contract to open, and you can close trades for free. They have a $10 commission cap per option leg. So for example, if you purchased 500 call options, you would not pay $500 for entering that trade. You would pay $10 in commissions for entering that trade, and you could close it for free. They also have free stock trading and a $10 maximum commission per cryptocurrency order. So if you purchased $8,000 worth of Bitcoin, you would pay $10 to enter that trade and $10 to close it. So if you're interested in checking out tastyworks to see if they're right for you, you can open and fund your first account with $2,000 or more and earn a free $200 stock bonus when you use the link in the description below. And if you appreciate the work I do here at the channel, it's a phenomenal way to show your support. Let's get back to the video. Now we're going to look at an example where we change the amount of time until expiration versus holding the stock price constant. So in this example, we're looking at a 100-105 call spread with 30 days to expiration and implied volatility held constant at 30%. So we're going to go from 30 days to expiration to 20 days to expiration to simulate the passing of 10 days. In this first example, we're holding the stock price constant at $100, and that means that the stock price is going to stay at the long call strike price of $100, and this spread will be fully out of the money and consist only of extrinsic value. So when we look at this graph, we can see that the spread's value steadily decreases as we go from 30 days to expiration to 20 days to expiration. And that's because since the spread is out of the money and consists only of extrinsic value, since extrinsic value decreases as time passes, the spread's value in this case decreases as time is passing, because the chance of this spread becoming fully in the money is decreasing because there's less time for the stock price to move and leave the spread fully in the money. That's how I interpret it intuitively. So now let's look at the same exact test, but in this example, we're going to hold the stock price at $105 as we go from 30 days to expiration to 20 days to expiration. As we can see here, the spread's price did the complete opposite, and the spread's price steadily increased as we went from 30 days to expiration to 20 days to expiration. And that's because since this spread was fully in the money and the stock price was right at that short call strike price, the spread's net theta position was positive, meaning that it benefits from the passage of time. And that's because since the long call is in the money and the short call is at the money, the short option is going to have a lot more extrinsic value than the in the money long option. And as time passes, the short option will decay faster than the long option, and that will lead to an increase in the value of this call spread as time is passing. So if you buy a vertical spread and the stock price is hovering near the long option strike price, your spread is going to have negative theta exposure, meaning that it will lose money from the passage of time. But if the stock price moves favorably and goes to your short option strike price, then the spread will have positive theta, and that means that your spread will increase in value and you will make money from the passage of time. Now let's bring it all together and look at a more dynamic example. And in this case, we're starting with a stock price at $200. And let's say a bearish trader buys a 200-180 put spread, meaning that they're buying the 200 put and shorting the 180 put, and they have 60 days to expiration at the time of entry. We're going to compare three scenarios here. The first is we're having implied volatility remain constant at 25%. The second scenario is we're increasing implied volatility to 35% over the life of the trade. And the third scenario is that we see implied volatility go from 25% to 15% over the life of the trade. And the last thing I'll mention is that we're going from 60 days to expiration to 30 days to expiration. And that means in this example, we're going to see 50% of the initial 60 days to expiration pass. As we can see, when the stock price falls from $200 to $180 over the first 30 days of this trade, all three of these put spreads gain value, which makes sense because they are all becoming fully in the money because the stock price is going from $200 to $180, which is the short put options strike price. So all three of these spreads are making money. However, in the early portion of this trade, when the stock price was closer to the long put strike price, these spreads have positive Vega. Now that means that the spread with increasing implied volatility is going to perform better than the spread in the scenario where implied volatility is falling. However, as the stock price moves towards the short puts strike price of $180, the spread's Vega position flips and becomes negative. So as we can see here, when the stock price reaches $180 after 30 days, the scenario where implied volatility went from 25% to 15% resulted in the highest spread price, and the scenario where implied volatility went from 25% to 35% actually resulted in the lowest spread price. So to make a long story short, if you buy a put spread and the stock price falls through your strike prices and is moving favorably, you want implied volatility to decrease because that is going to result in the highest spread price when your spread becomes fully in the money. But unfortunately, in the real world, when stock prices fall, implied volatility typically increases. So it's just helpful to know that in that scenario, when implied volatility is surging and the stock price is falling, that increase in implied volatility is going to fight against the profitability of your vertical spread. If you're buying vertical spreads, meaning you're buying call spreads or buying put spreads, if the stock price is at or near the long option strike price, then you will have negative theta and positive Vega. But if the stock price moves favorably to the short option in that long vertical spread, then you will have a positive theta position, meaning you will profit from the passage of time, and negative Vega, meaning you will profit from decreases in implied volatility. If you're trading credit spreads, meaning you're shorting call spreads or shorting put spreads, then if the stock price is at or near the short option strike price, you will have negative Vega exposure and positive theta exposure, meaning you will profit from the passage of time and decreases in implied volatility. But if the stock price moves to one of your long option strike prices and that credit spread becomes fully in the money, then you will have a negative theta position and a positive Vega position, meaning that you will lose money from the passage of time and you will make money from increases in implied volatility. If you haven't seen it yet, be sure to check out my ultimate guide to vertical spreads for beginners, which is going to be this video right here. If you haven't seen that video, it is basically a free masterclass on the vertical spread option strategies, so be sure to check that out. I'm Chris from Project Finance, and I will see you in the next one.